Hey there, and welcome. So, you're starting a business. That's amazing. But I bet you have a million things on your mind, right? Well, today, we're going to demystify one of the most important ones, insurance. We'll break it all down so you can feel confident about protecting this thing you're working so hard to build. I mean, just think about it for a second. What if a key employee gets hurt? Or a fire damages all your inventory? Or a lawsuit just pops up out of the blue? These are those what-if moments that can totally derail everything you're building. Managing that unknown risk, that's what this is all about. And that's where this comes in. See, insurance isn't just another bill to pay, it's a tool. It's basically a financial safety net, right? It's designed to catch you when one of those unexpected things happens. It gives you stability and peace of mind so you can focus on growing your business, not just trying to survive. So how does this safety net actually work? At its heart, it's more than just a legal contract. It's a really powerful idea. And it all comes down to the concept of community and sharing the risk. Okay, so let's break it down. At its most basic level, insurance is a contract. You, the business owner, you agree to pay a small, predictable amount of money. In return, an insurance company agrees to take on the risk of a huge, unpredictable financial hit. It's really just a simple transfer of risk. Just imagine a fire causes, say, $50,000 in damages to your shop. For one business, especially a new one, that could be it, game over. You'd have to cover that entire cost all by yourself. But what if 1,000 businesses all chipped in $50 to a big pool of money? Suddenly that $50,000 loss is covered, no problem. And that right there is the magic of insurance. It's called risk pooling. The insurer spreads the cost of these unexpected losses among a whole lot of people, which makes it totally manageable for everyone. All right, so let's get into the nuts and bolts of how this all actually works. You kind of have to learn the lingo to know what's going on, so we're going to break down the key players and the words you're going to hear all the time. Okay, first things first, you've got two main players in this game. The insurer, that's the insurance company. They're the ones taking on the risk. And you, the person or business buying the protection. You're the insured. Simple as that. So that agreement between you two gets put into a formal contract, and that's called the policy. Think of it as the rule book. It spells out exactly what's covered, how much is covered, and just as important, what's not covered. Okay, next up is the premium. This is simply the money you pay, usually every month or every year, to the insurance company. It's that small, predictable price you pay to get rid of that huge, unpredictable risk. Paying your premium is what keeps that safety net ready and waiting. All right, so what happens if you actually need to use your insurance? Well, that's where the deductible comes in. This is the amount of money you have to pay out of your own pocket before the insurance company starts paying. It's basically your share of the bill for that specific incident. Okay, you might be wondering, how on earth can an insurance company afford to take on all this risk? Well, the answer is all about math, specifically something called the law of large numbers. Think about flipping a coin. If you flip it just twice, who knows, you might get two heads. But if you flip it, say, 10,000 times, you're going to get super close to a 50-50 split. By insuring millions of people, companies can get really good at predicting how many claims they'll have to pay, and that makes the whole system work. Okay, so now that we've got the basics down, the next big question is pretty obvious. What kind of protection does your business actually need? Let's dive into the major categories of coverage. So, pretty much all insurance can be sorted into two big buckets. You've got property and casualty, which covers your stuff and protects you if you're legally responsible for something. And then you have life and health, which, you guessed it, covers people, like you and your employees. For a new business like yours, there are really three types of coverage that are, non-negotiable. First up is liability insurance. This protects you from having to pay huge legal bills if your business accidentally causes an injury or an accident. Next is commercial property. This covers your physical stuff, your building, your computers, your inventory, from things like fire. And finally, if you have even one employee, you need workers' compensation. It covers their medical bills and lost pay if they get hurt on the job. And finally, let's tackle the big question everyone has. How in the world do they come up with the price? How do insurance companies decide what your premium is going to be? Well, it really comes down to three main things. First, the insurance company looks at your specific risk profile. Second, they use tons of data to predict how likely it is that a business like yours will have a claim. And finally, they do the math to calculate a premium that will cover those claims, pay for their own expenses, and hopefully make a little profit. So when we say your risk, what does that actually mean? Well, it's a bunch of different things. Your industry. I mean, a construction company is way different from a marketing agency, right? Your location.
Are you in an area that gets a lot of floods or storms? How much coverage you want? The higher the limit, the higher the premium. And yeah, your own history with claims plays a part too.
But here's something you actually have some control over: your deductible. It's a really simple trade-off. If you're willing to pay more out of pocket when you have a claim, that's a high deductible. Your premium will be lower. If you want the insurance to cover more of the cost and you pay less out of pocket, that's a low deductible. Your premium is going to be higher.
And really, that's the whole point of all this. I know insurance can feel super complex, but once you get these basic ideas, transferring risk, pooling it together, and how it's priced, you're not just blindly buying some policy. You're making a smart, strategic decision for the future of your business. So, I want to leave you with a question. Now that you've got the basics down, what's the first step you're going to take to protect your future? Maybe it's just reviewing the risks you have right now, or maybe it's getting your very first quote. Whatever it is, taking that step is a huge move towards making sure your company is secure for the long haul. Thanks for tuning in.